Chris Hodson from Edgewater Research is with us today to speak on balancing industry consolidation with marketplace expansion. Chris has been an overall favorite speaker at BSA Forum for many years, always provides us with in-depth analysis of the industry over the last year. So let's give Chris a warm BSA welcome back.
Thanks a lot. Thanks for having me. This looks like a pretty long, fancy title for a presentation, but I've got an agenda that'll sort of follow that. But a quick background, on our company. I think a lot of you are at least vaguely familiar with what we do. In the simplest terms, we analyze stocks, and the way that we actually do that is we network with a lot of people in the industries that we cover to figure out what's new, what's interesting, what's changing, those sort of things. Our company focuses mostly on 3 specific verticals. I'm on the retail and internet side of things. We also have a technology side of the business, although it's more into pricing of memory and semiconductors and things like that. I don't think we'll get into it today. But the thing that gives us sort of a unique insight is we cover a lot of different areas of retail. So that helps us to connect the dots a little bit. We don't necessarily need to be the smartest guys in the room. We just have an extensive network in a lot of different areas. So we'll touch on areas like the automotive aftermarket, the auto parts stores, the office products retailers. We cover consumer electronics, even recreation and power sports. I was in Minneapolis last month riding ATVs through the woods. This is a little different forum. But that's the basics on our company. Our main clients are the institutional investors, and then we also do a subscription business in the channel and things like that as well. So the first thing a lot of times people will come to us with is, hey, I'd like to talk about your broad opinions on this industry or that industry, but right off the bat, what's the most interesting thing you're seeing right now? What's the biggest change you've seen in the past couple months relative to where things had been trending earlier in the year? So I'll touch on the sort of top layer of a couple things. We'll get into the Amazon issue a little bit later, but these are the main things. Number one, Amazon's done a total 180 in terms of what's important to them. I was up on the stage last year talking about how, hey, all they care about is profitability. They're getting rid of all these cannot realize a profit items. Look at the margin flow through, this, that, and the other. Revenue had fallen off from a growth perspective, I think a little bit more than they would have cared for, and so we've seen a reversal there. The second thing, tariffs, people are constantly asking us about whether it's somebody on the dealer or retailer side or even in the supply chain community. Without getting too in-depth, wanted to give you our highlight thoughts, what we're seeing, what we're hearing on that side of the business. So we talk a lot about crap. Everybody knows the acronym. Amazon's cut the crap and then some. And this is the top layer of what's changed in the business. I'll get into the specifics a little later. But if you look at paid unit growth, this is a good thing to look at for Amazon. There's some noise associated with this number as things move from physical to digital, but it's a decent bellwether if you look at every quarter. What are the actual units going out the door here? And this had been down for 7 quarters in a row before this most recent second quarter, and you can see a pretty significant change here. This had basically been something that was a mid-20s grower for several years, down 7 quarters in a row. We're as low as only up 10% in the prior quarter, and now suddenly we shoot back to 18. So with a company the size of Amazon, that takes a lot of change, and I'll get into what we think's going on a little later. Same thing within North American retail. If you back out some of the noise again in the numbers like currency and the Whole Foods acquisition, that's sort of a different game. This has followed the same sort of path where we're mid to high 20s growers for a while, 4Q and 1Q, it's more in the 20% range before you get a big bump here in the last quarter. So for reference, I mean, if we're talking about North America in just one quarter, the difference between 19 and 23% growth is about $1 billion. So it takes more than just a kind of a subtle shift here and there for $1 billion in revenue, variability. Now, this is the other side of the equation. We talked about forever, the last several quarters, hey, this has been all about profitability. How much can we bring to the bottom line? And, one of the variables you can look at that is, what are the net shipping costs ended up being? Because that's certainly a portion of the profit equation that they look into. And for multiple quarters, just in the past little bit here, you've seen some pretty nice leverage on shipping costs here, even to the point where in 3Q of 18, right around this time last year, we saw for the first time their actual shipping revenue received from people was greater than what they actually spent. Now, that's gone totally in the opposite direction here in the last couple quarters, as the company has not only just lowered the thresholds on what they're willing to sell from an item basis, but also has really poured a lot more of an investment into the transportation side of the equation, including Prime One Day and the incremental fees that go along with that. And this is just the all-in profitability. You look at what gross margin has done, simply put, for this company over the last few years, significant increases, all-time highs, this, that, and the other. And then, of course, just this last quarter, that's the least margin expansion we've seen from them in the past few years. So a sea change here. They even will get into it and say, okay, margin was up about 0.5 point year over year. A little bit over 1% of that was the incremental cost associated with Prime Now. But even then, we're talking less margin expansion than we had been. So total change in mentality from them. I'll get into the puts and takes of that a little bit later. And then here's our sort of trade war quick takes. A few things to note. We talked to a lot of people in various industries that track this a lot more closely than we do from a political perspective. And one of the things we'd call out is that, in early August, when the list 4 of tariffs was announced, China sort of immediately responded with their own retaliatory tariffs associated with that. The people we know that are closer to the story thought that that was a pretty significant escalation, or was not expected. And interestingly, just this most recent round of the additional increases on list 4 and list 5, of another 5%, China really has taken a more guarded tone there. So that's good news in terms of the escalation of that. A lot of the people that we know that are closer to the story, they pay a little more attention to what China does, simply because they tend to have a slightly more pragmatic approach than our current regime, to understate things. So that's something that was a little out of the ordinary, that we picked up. Secondly, a lot of production seems to be moving out of China already. And we'll go industry by industry, but we've definitely seen brands using that as a tool of leverage, both in negotiations with their factories or, not as a negotiation ploy, but hey, let's diversify our supply chain a little bit. So that's helped mitigate a lot of these tariffs in areas where people can do so. The last thing that, the effect on demand to this point has been less than we would have thought. And granted, the retailers we've seen have been much more diligent in pushing through increases on non-discretionary items and trying to sort of toe the line on discretionary items and not push through as much price. And also you've had a couple other, tailwinds from currency and things like that in the wings. But to this point still, our worry on the whole trade war is more the overall impact on consumer spending that we think is going to come down the line from, this inflation that's across the board. Once people start to run out of mitigation tactics and we see more wholesale across the board inflation, what does that do to consumer spending? But at this point, the impact is more of a hypothetical thing we're worried about going forward than necessarily a huge thing we're seeing at the consumer level broadly right now. Just a couple examples from where we cover. Footwear is an interesting one because everybody thinks of that as, all of that is made in China, or at least most of it. And it's actually closer to like 70% of the total, but that's partially because a lot of athletic footwear, some of the big guys is made outside of there. But here's a really good quantification of the pace of things moving outside of China. DSW, one of the retailers that we follow, they'll talk about last year about this time, 10% of the product was made outside of China. Now it's closer to 20. Hey, over the next 12 to 18 months, maybe it's in the range of 40. So you're seeing some migration there. Vietnam is something that comes up a lot in sort of those, what we would call soft lines areas of retail. In more of the hard line side, Taiwan is mentioned a ton, whether you're talking auto parts or power sports or things like that. The one area where we're not seeing much movement at all is technology, your components for, phones, computers, things like that. That's where the pressure has been a little tougher to push off. And actually, that's the one area where we've seen more sensitivity to price. Whether it's Best Buy or Amazon, those guys have been a little more reluctant to try and pass on those increases to the consumer than some of the other areas of retail, like, automotive parts, where those retailers have just passed on the increase, because it's viewed more as a non-discretionary item. A few of the things I touched on briefly there that are helping. Currency is devalued quite a bit. Most people talk about a 5, 6, up to 8% type benefit from that of just going back to the factory. And you take into account using moving out of the country as a leverage tool. That seems to be helping mitigate some of the costs. The impact on the discretionary element, like I mentioned, that's been a little different, where we haven't seen all the price flow through. Non-discretionary has held up a little bit better. Again, the main concern would be, hey, what happens down the road when the consumers had to absorb these higher prices for a year or so on items that they're not used to. Maybe the individual purchase doesn't have a huge impact, but the collective increase and impact to the bottom line, shows up more predominantly. So those are the big, disruptive themes we're hearing right now. I'll get into some of the industry portion of things here, and then we'll finish up with a bunch of Amazon stuff that's going on. So, if we look at the depot, composition of what's going on, I know those guys are going to talk in a little bit, so I hope I'm not stealing any thunder here. But the way we look at this story, at least as far as the commercial business operates, right now it's a flattish organic business, and then you're getting 2 to 3 points from, your acquisition pipeline. That's what we've seen over the last, several quarters, at least here. A little bit of sluggishness in 1Q that can be attributable to some government and public issues going on during that time. That's, close to 30% of the BSD mix. So that was part of the issue there. The good news here, as far as the acquisition side goes, we'll hear a lot about, hey, the price that is being paid for these is pretty high. Are they going to retain all of the business and that sort of thing? To this point, it hasn't been overly dilutive from a profit standpoint. And actually, we're seeing 2019 ahead of 2018 from an overall profitability standpoint, from an operating margin perspective. And it's closer to where 2017 was, as sort of where we're tracking. So that speaks to a few things. Number one, the retention on the business has at least been okay. Number two, it's not all just lower margin, unsustainable business that's being brought in, which bodes well going forward as you're looking, to what the sustainability is like here. That's a positive. As we look forward, some of the other things that we're seeing, there definitely seems to be a little more volatility here. We think part of that is, look, over the course of the last couple years, this has been a pretty rationally priced environment. You've had staples that's a little bit more margin conscious. You're not sort of seeing the contract price wars that are out there that maybe we had seen in the past. However, at the same time, Office Depot has probably been a little bit of a price leader. So, is their customer base a little more price sensitive to the point that promotions will result in some higher highs and lower lows? We think that's part of it. So it just seems like a little more volatile business relative to the other guys. The contract flow we still think is probably a net positive. I'll get into staples in a little bit, but long story short, they've been a lot less aggressive on the contract side, period. Especially we've seen this in government and school. So the net contract flow is still good for these guys. Last thing to note, there's been some inflation, in paper and Office Depot with some of these extended commitments in terms of holding price on these contracts for a while. Got a little bit behind the curve. That was something that was somewhat of a margin drag for a couple quarters. That seems to be reversing. So some of the main puts and takes involved with the business right now. As we're looking forward, we think BSD is probably more of a low singles, kind of grower. The company's even talked about, maybe 1% to 2% type acquisition benefit over the balance of the year. You can reverse engineer the math even a little bit. When it boils down to it, the BSD investment plus acquisitions, $5 million in 1Q, $18 million in 2Q. You can kind of do the math and figure out what that really means from a annual contribution run rate. Last year, for instance, the benefit from acquisitions was a little over $100 million. So that's sort of a run rate to think about. Retail, we're not seeing a whole lot that's going to change there. We still think that that's probably a down 5 business in total, down 3 to 4 if you're just looking at from a comparable store sales basis. They're closing around 50 stores or so, and then the inflationary pass-through, like I mentioned, that should help a little bit as we're looking at second half of the year profitability relative to where we maybe started the year off. The Alibaba thing, I think it would maybe be a bigger point of conversation right now if it wasn't for the trade war and sort of the US-China implications. I think even the company has maybe been a little less vocal about that partnership than maybe we saw earlier in the year. But on paper, this can make a lot of sense, certainly in a best case scenario. If you're looking at what everybody can bring to the table, Alibaba's looking for a foothold here. At this point, the legitimacy, I think, is a real question mark. A lot of people will call them, the single most prominent counterfeiter in the retail universe right now. So that's a little bit of an issue. Depot maybe legitimizes them a little bit, and they provide huge access to the enterprise customer level. And the benefits for Depot are easy to see in a best case scenario as well. One of the reasons the wholesalers have been, popular over the last few years is the fact that to have an endless aisle of inventory is a lot of work and a lot of working capital commitments. If Depot can lean on somebody like Alibaba with a global sourcing platform, that allows them to potentially grow share of wallet without necessarily committing a ton of resources to it right off the bat. And then you look at the traffic side of things. Any retail website outside of the Amazon, Alibaba sort of ecosystem struggles to generate enough traffic to really be a significant driver at this point, especially when you consider, that a lot of these guys, Office Depot, Staples, have been a little less aggressive on the pricing side online. I'm sure some of us have noticed. So the ability to leverage that traffic as well is probably something that works in a best case scenario. So yeah, the benefits here are obvious. I think a few things to think about as far as the near term goes. Right off the bat, we're not baking in much of a accretion from revenue this year from this sort of platform. It's really heavy on pilots and tests and things like that. In fact, there's probably a little bit more investment, than we necessarily even see as return from sales in the ultra near term. The US-China trade thing, like I mentioned, certainly a huge portion of this is inventory from China. It's a large part of the Alibaba global sourcing network. That creates some issues. I think this in the near term is being talked about more as a US sellers to US businesses kind of dynamic. It's entirely B2B, at least right now. I think that if you look, Office Depot's been pretty apparently, selling on Amazon as a third party as well. We'll get into that. I think that's probably one of the ancillary benefits, but mostly a B2B type issue. And then the counterfeit thing is the one piece that we're really keeping an eye on. This has been drawn into the light by some of the things going on at Amazon in the marketplace, certainly over the last few months. And Alibaba's track record with that sort of thing is probably perceived to be a little bit worse. So that's kind of one of the issues out there. Now, Office Depot and some other people somewhat fairly will throw some water on that counterfeit issue and say, hey, look, the B2B marketplace is less of a Wild West scenario than we have on the consumer side. Those sellers are more heavily vetted. That could be Amazon will make that case on the Amazon business side as well. But that's one of the things that they'll come back with. The fee structure, I'm not sure how many of you know, but Amazon, if you're selling as a third party, you pay a percentage of your sales. It's generally in like that 15% range. Alibaba is more of a membership fee type thing. So based on the volume, this could be a little more profitable scenario if you're looking at, is Office Depot going to direct more product through here than the Amazon third-party marketplace? That's something to consider. But the real big advantage is, hey, in a perfect world, we can offer a lot more product and we don't necessarily have to manage the day-to-day on that. We know at this point that businesses more and more, especially the small ones, are acting like consumers. They buy all sorts of stuff. I'm on the extreme end. We've got about an 8-person office, but we don't necessarily buy all business type items, So that's the main puts and takes along with that one. Yeah, quick question? Yeah. Yeah. I thought we'd get this question. Yeah, at this point, I think that I actually talked about this earlier. I don't think that the company is really getting, the street's not tying any real positive value at this point, it looks like, to the retail business or CompuCom, which is not necessarily unfair. The retail business was barely profitable in 2Q. BSD was 90% of the operating income, essentially. So I think what now, our clients would basically tell you if they were up here is that, the stock's valued on the BSD business, which was a $250 million operating income business, and it was probably going to be flattished up slightly, and that's why the stock is where it's at. They're basically discounting the contributions that they're currently getting from retail and CompuCom, which makes the stock look really cheap if you can depend on those cash flows. But I think there's some, lack of visibility there. I think too many stores right now, but I don't know who the buyer is at this point. I think the much more likely scenario is that, they'd get bought by somebody on the e-commerce side of things. We just mentioned, obviously, there's two huge e-commerce players in this business, and Depot at about $1 billion market cap company. Does it make sense for somebody to just buy the B2B side of that business, essentially? I would think that would be more likely than private equity. But
just so, is this on? Just so everybody can, if you fill out a question card, do me a favor, raise your hand so I can come get it. And two, if you just give me 1 second, I'll run to you with the mic when you ask a verbal question. Thanks.
I've got a lightning round planned for later, too, so we can do that. On the Staples side, in this whole conglomerate, going to run through a few of the most interesting things we're seeing here. This company's been maybe perhaps a little too margin conscious, over the course of the last couple of years, which isn't surprising given, the change in ownership and things like that. But, at one point we were seeing promotional paper as high as like 37, 38 range. Our understanding is units fell off quite a bit, associated with that. And we've just started to see some signs of them maybe shifting back a little bit more. I don't think you're going to see anything ultra aggressive or anything from a price war, perspective on the contract side of the business, but maybe they'll be slightly more aggressive than they had been. It's been pretty benign over the past couple years. The True Red program, I think, is a pretty big jumping off point for private label. The timing of that ahead of tariffs, it's always difficult when you move something to private brand. You're really on the hook for all of those increases that maybe you could share with the supplier community sometimes if it was the other way around. So that's a pretty big initiative with, pretty unfortunate timing as far as the tariff goes, something we're keeping an eye on. Cost of goods synergies. They've obviously talked a lot about that for the dealer, hoping to get, a lot of concessions on the supplier side. We're seeing the same thing here that we saw with Depot Max a while ago, where, this is a supplier network that has, pretty emphatically supported these guys over the years from a financial perspective, and there's not a ton left from a synergy angle. So that's been the feedback that we've gathered. A few other things, some lower pricing on private label to dealers to try and win some business. Again, just alluding to the fact that we've maybe seen a slight reversal in the trend in terms of how aggressive they're going after things. Some willingness to definitely step away from the real larger, lower margin accounts. That's where, we seem to hear more about wins from Depot. And then the merchandising side of the business, I think, is a question. Obviously, there's been, a lot of turnover in the wake of the multiple deals here. So I think there's some confusion as to, Staples is buying for a wholesaler in a lot of ways. Do they totally understand, that side of the business? And definitely you've had a bunch of turnover as well, where there's always a learning curve associated with that. So talking about the private label impact, this has been a big point of discussion on our end. Clearly, it's a big focus for the company. So just diving into some of the variables here, core office categories are pretty certainly the point of disruption at this point. There's some elements of the assortment that have had a higher tilt to private label for a while, others that they're not really getting into. But, you take a look at pens, for instance, if this is just a totally non-branded search, you basically only have 8 True Red SKUs in total, but yeah, they're the first 8 things you're gonna see as you scroll through here. So any sort of non-branded type item, they're pushing private label pretty aggressively, both on the internet and, tangibly in the real world as well. Coast-wide, interestingly, it's a banner ad for a different private label product they have as well. So, we look at private label and, we see it in a lot of different areas of our coverage, whether it's auto parts or shoes or apparel. And there are a few standard pitfalls that we've come across, but it seems like when private label really works, it's when it's a relatively smaller piece of the assortment just because it's easier to manage and you can pick off the things that make obvious sense. You lose a lot of flexibility with that. A lot of times we see, it's easy to get caught up in what the initial markup is on these sort of things when you're doing it all direct. But the flexibility component, we think it gets exponentially tougher to manage once that mix grows. So for instance, 40% of the mix being private label versus 20, that's a lot more than double the degree of difficulty in our line. And there's a couple areas where, we see private label work, and it's generally where, hey, you've got really low turns on an item. So we can get burned by having too much inventory, but other than that, we can't get in huge trouble on a low turning SKU, for instance. Cost in an inflationary environment, that's difficult to manage. So we're starting to see, I know this industry, and actually Office Depot's probably done this more than Staples, has ebbed and flowed between private label, and we're starting to see this maybe get to the point where it becomes difficult to manage just from the scope of the work involved. And the environment probably doesn't help right now either. The good news is, if I was a brand and kind of measuring the hostility of a company towards brands, this would be one of the things I would look at today, and that's, hey, are we searching for brands or not brands? So the regular pens search is going to return a whole bunch of, hey, we're going to shove True Red down your throat. But, if you're as a consumer looking, hey, Bic pens, they're not going to flood this with private label product yet. So that's something I'd keep an eye out for, just from my own opinion. That's one of the more hostile things. If I'm literally doing a search for a Bic pen, I know what I want, and all I'm going to get is, sort of private brand type things. So something to keep an eye on there. Real lot of questions, what's going to happen here? And, we really have two things. WB Mason, at some point, was probably part of the process here, and that hasn't totally come to fruition. Maybe if that was part of the equation, this is more of a long game business that Sycamore holds on to for a while. But at this point, we've been covering retail stocks since 2007, so we've seen this rodeo a few times in terms of, a public company gets taken private, gets flipped back public, and if there was a checklist for this, Staples has kind of checked off a lot of this, right? We've said a leadership change, we came in, we sort of stabilized margin structure, no more crazy online promotions, let's not give huge upfront rebates for large contracts, things like that. And then, hey, we're even going to add a bolt-on acquisition on top of it. So this is kind of the, almost 1, 2, and 3 that you'd go through if you're a private equity company buying a organization that you want to flip back public. So that seems to be the path. I'm not speculating or anything like that, but based on what we've seen historically, that's sort of the path that this thing goes down. Okay, so into some big Amazon changes here that are relevant in terms of this industry. This huge change in thinking from them has been, a little bit about price, but not like you normally would see. The real drivers here are selection, and I mean that in multiple areas. Not only adding back less profitable SKUs, but adding the SKUs that are available on one-day delivery, or getting a little bit more aggressive on subscribe and save, or eliminating the add-on program. There's sort of a lot of different ways that Amazon adds selection back in. And we think that's probably been the single biggest driver to this turnaround over the last few months. Secondly, investment. This company, we'll get to it in a little bit, but they're earmarking another $800 million a quarter at this point, solely dedicated towards the fulfillment network. And the interesting thing about that is they're not even building any more fulfillment centers. They're sort of already good on that front. So the $800 million is going entirely to a bunch of other variables we'll get into in a second. And then promotion price has been a little part of it. We think that's sort of the distant third, but if you look in a vacuum at something like Prime Day, they were considerably more aggressive this year in the inventory buy-ins, the chances they were willing to take on selling product that they maybe didn't even have in stock yet. There wasn't nearly as much deal suppression as the last year when they sort of make it tough to find a deal. So different across the board here. And a lot of times people will ask why, and there's a bunch of reasons. We think this is a pretty big part of it. So Amazon's other revenue growth is mostly advertising. Okay, they'll break this down in the P&L. There's some stuff you can strip out, but this is mostly advertising revenue. And this is a significant portion of the operating income of the company at this point. And you know what? What happens when we eliminate a bunch of small, low ASP items that we can't sell a ton? Well, or can't make a lot of money on? Well, generally, a lot of these items are from the really large companies that are heavy ad spenders, right? It makes sense. Your more impulse items that can be influenced by advertising are less expensive product. So what we've happened here over the course of the last several quarters is that advertising revenue growth, we went from 50, 60, 70% range, which you can't do forever, but the scale of the slowdown as they cut back on selection was notable. It makes sense just because, hey, we're getting rid of these items. That's also just less inventory for them to sell ads as well. So while selection has been the big needle mover in getting revenue back going, we think it was one of the real detractors to why advertising revenue had started to slow over the last few quarters as well. A couple other reasons too, share loss. I think there's been a big narrative over the past year about Walmart and Target and click and collect working. I think that irked Amazon from a competitive standpoint. And then if you look, share of wallet's going to have to be a lot more important for this company going forward. They'll even be candid about Prime member growth slowing down a little bit. So a lot more of the growth is going to have to come from just getting a larger portion of household spend. And this is how I'd quantify advertising profit. Amazon will give you these numbers on the left, right? They'll tell you, hey, we're making about $7 billion in North America retail, making about $7 billion in AWS, and we're losing a couple billion internationally. This is probably the real way to look at it, though, and that means, hey, retail in general is a break-even business, and then we get $7 billion from AWS and $5.5 billion from advertising profit. So Wall Street is a lot more well aware of this now as well, so I think that slowdown in that advertising profit is part of the reason that this business has sort of really picked back up in terms of being aggressive going after selection. They've added selection in a couple different ways, like I said. We're rolling out Prime one day. I'm sure we're all consumers. We've noticed a lot more of our items showing up a little more quickly, especially if we're close to like a large urban area. If you kind of harken back to some of the early charts I had up there, the change in paid units compared to revenue was even more significant, which implies that, hey, a lot of this rebound has been on some lower priced items. If we're seeing a larger increase in units than we necessarily are in dollars. And then removing add-on items is a big one. We think this happened right around Prime Day. That drives a ton of growth in convenience items. Consumers find these quick. So I have a bunch of examples around that. I think most are relevant to the industry, but okay, let's take the G2 pen. It's classic, everybody knows it, just a 2-pack. This is something that a year ago at this time, there's no way Amazon's selling just a $2.92 item, Prime, by itself. This was an add-on item probably, well, I'd say very probably. The only reason I'd say not 100% is I can't go back and find it. But this is a good example. Something that not only would Amazon not have done this in the last couple of years, but I don't think they would have done this 10 years ago. And the examples actually get more extreme from here. Hey, it's back to school time. Crayola, is a classic. think I've probably even talked to some of you in this room. If you're seeing anything weird in the back-to-school business, I think what Amazon is doing is part of the reason for that. You know, they're being a lot more accommodating on these eaches items than they had been in the past, and that's taking away a lot of volume from some other areas of back-to-school. I know the suppliers we have in this neck of the woods, you know, are having huge couple months here on Amazon. But yeah, here's a 79-cent item. You can get it via Prime. Again, something that I don't even know would have been on the website a year ago, let alone 10 years ago. This is like the Amazon doesn't care about making money stage of the company. Also, if these come without breaking, you're probably, yeah. Oh, crease brush, this is another one. I said we'd get more extreme. We're 75 cents, and it's actually buy one, get one 50% off. Again, prime example of what's going on here. And then I think the last two, well, I'll only do two more, but these are probably the most extreme. So this is a tool, actually, this size is misleading. It's really about like the size of a watch. But this is a 15-cent item, and there's free returns. I had to buy this one. It is a little misleading, though. It's 16 cents after tax. So, but this is something where it comes in an envelope that had to cost $2.50, $3 to ship. It's a 15-cent item. You can return it for free, which actually it was a lot smaller than it looks here. So, you know, this is something that's nowhere near profitable. And like, this is almost to the extent that we wonder if something as weird is going on with the algorithm, because we've never seen prime eligible ASINs at this low of a price in a decade. And this one I'd argue is maybe the most extreme, and this, you know, probably ties into the industry. So we're actually, this is $5, but the problem here is anything that is 12 by 11, I mean, this can't cost less than $10 to ship. And this is the trifecta because we've got free returns and it's coming tomorrow. So the reverse logistics of this sort of thing is, you know, the poster child for what's changed at Amazon in terms of the aggression from a price perspective, the change in thinking around profitability. So reading the tea leaves on some of the seller tools that have been rolled out as well. I know there's been some talk around this too that we can get into. But they rolled out a whole bunch of things. 3 of them I think are interesting if you're looking at like what's the long game here. Because really if you look at all the pricing discussion I just talked about, what we think has happened is, you know, over the last several years, suppliers have, you know, gone through the normal ringer where you have a large company, they get bigger, they push for more and more margin from the supplier. Suppliers are working on thinner and thinner margins. What a lot of people did is they said, hey, let's take our most profitable items and let's actually move those over onto 3P. Or even let's do those FBA, because the 15 to 20% that we're giving Amazon as a commission, hey, we're still going to end up making more money in that channel. And that's not good for Amazon. That's high margin items that are no longer a direct relationship, and it's less selection for them. So it puts some market share up for grabs. Now, I think we're starting to see them go back, realize some of that. They don't want to go through that dynamic where, you know, all of our profitable items are on 3P. We're at the whim of other people fulfilling. And then on our own direct retail site, not only do we have less items and less control, but we've got all the less profitable things as well. So a few different things here. I'll go into the background on all of these. So sold by Amazon, the basic gist is they're coming to you as a brand 3P seller, what have you, and they'll say, hey, we got this free opt-in service. You don't have to worry about the price. We'll determine that. Similarly, like to FBA, it's almost sold on consignment to an extent. The difference here is there's a guaranteed margin and sometimes even revenue for the seller. So that sort of built-in floor has some allure if you're going to do a whole bunch of volume, and you don't want to worry about the constant price management or things like that, but there are a few catches here. A couple other like real benefits. The seller does get out of the whole tax nexus. It's sold on consignment, so that's on Amazon. And it's all Prime eligible. So in a lot of ways, it is more of like a 1P direct sale, because even though it's on consignment, it's sold by Amazon. It's sort of a gray area at this point. But, the real catches are generally, even though there's this minimum margin or sales level, they're low, to the point that it's not, in a lot of cases, not worth a vendor going from vendor central, over to here. Same thing on the seller central side. And, I think the long-term goal, which I'll get into in a second, is maybe this is more of a brand-friendly approach, but it doesn't make any friends in the near term if I'm purposely avoiding Amazon for a lot of issues tied to the third-party marketplace, this, that, or the other. Now it looks like Amazon is somehow directly getting my product and selling it from a different 3P seller just because they signed up for sold by Amazon. What I actually think is going on here is that in the long term, this is more of a, hey, we're a friend to the brands now, because Amazon has been, I think in a lot of cases, anti-brand for a while. That'd probably be most of the experiences of vendors in this room. But what are some of the things that vendors don't like about these guys? The 3P marketplace pricing is dilutive and it's ripe with counterfeit type goods. Maybe they can go out to everybody and say, hey, why don't you give us more control over the pricing in this channel? Over the long term, they get enough people on board that now this is something that's less of an issue and they can onboard some of the new brands that they want. And then the second point gets into what I was hitting on a little bit earlier. They want to control what they're selling on 1P versus 3P. We talked about the whole one vendor dynamic last year, where we think eventually, a lot of the brands in that $5 to $10 million range, they might want to have on the 3P marketplace for a few different reasons. But all the high volume, high profit items, they want to have on 1P. And if they have more people on the sold by Amazon platform, that's more control over general pricing, and they can dictate where things end up from where the sales actually happen. A couple of the other ones that were interesting for us, both of these sort of scream that they want to outsource a portion of the vendor manager job title and basically make more of this an automated process. Target inventory levels. Hey, not only do we want to dictate what is sold where, we want to let you know how much inventory you should have on hand. And product opportunities is the same thing. Hey, we'll use algorithms and things like that to determine what your peripheral opportunities are based on the items that you're selling right now. So, they're already dictating the price and sold by Amazon, maybe, eventually, and now you're dictating the inventory levels and what people sell to some extent on the 3P side as well. So that's just our long game view. Like I said, I think a lot of this is automated, which shouldn't come as a huge surprise. And to some extent, it makes sense. I mean, if Amazon's vendor managers are managing 2,000 brands, does it make sense to let the algorithms take the wheel on a decent portion of those? Sure. So I think that's a big part of it. That's a big cost savings opportunity. They're very serious about one-day Prime, obviously, and if they can control inventory levels from other third parties to help that initiative, that's a big component of this as well. And it lets them decide what they want to sell 1P and 3P. Lastly, just going to touch real quick on the logistics and B2B side, because there's not a ton new here. But we almost joke that every couple years, Amazon decides, hey, we're going to get back into the B2B space. We've got this initiative, that initiative. To this point, there hasn't been a ton of traction here, but here are the newest talking points. Progressive pricing. They've talked about this to some extent before with bulk discounts and things like that, but this sounds like an easier self-serve model where the discounts just build through the year as you buy things. They do seem to have gotten a little more traction with schools and government, but there's some thought out there that that's more based on the demographics of that end user versus anything Amazon's done. Those guys can tend to be a little bit more self-serve on basic type supplies. So that's a little bit of it. Maybe it's more of a correlation versus causation kind of thing. And then the logistics side. This is relevant for B2B because I think one of the topics we've talked about over the last few years is the huge advantage that a Depot or Staples or any of the wholesalers had is, next day delivery is nothing new in this industry. People have been doing it for a while. 2-day prime is great for a lot of things. It's not good on the enterprise level. Well, we're going to get to 1-day prime probably in most of the areas that are really important. So that's a little bit of a game changer. I talk about this nearly $1 billion a quarter that they're spending to build out 1-day prime. Like I said, the interesting part, no fulfillment center builds with that. It's all planes, trucks, paying FedEx more money until we can do it ourselves. Those sort of variables generates a lot of growth in those ASP items. You'll see if you look up a lot of the examples I referenced earlier for the extreme things, you'll see more out of stocks than you typically do on Amazon. It's because the consumer finds those in a hurry. If I have 2 items, they're both the same price, same exact thing. One of them's prime pantry, where I have to buy a whole box of stuff, and the other one I can just get as an each. That volume's going to happen a lot quicker. So the other thing, too, is we think, with this 1-day shipping, a lot more is going to get filtered to FBA. Right now, there are a lot of third parties that can ship 2-day, no problem. That's been table stakes in a lot of instances. Not as many people can do 1P. So that's going to move more from 3P, seller fulfilled, to fulfilled by Amazon. I believe that is what we've got. So the slide deck, we'll make it available. If you have any questions about what we do, my email's not really hard to figure out. It's chris@edgewaterrc.com. I have a couple things up there that we didn't get to in case people had questions on them. But we can open it up from there. So,
does anybody have any cards? Okay, so let's open it up. Who's going to be my first person to ask a question? Anybody?
Terrified.
Think about it.
You guys are nice
I know
this year.
This is as quiet as this group's ever been in their lives. Come on now.
Chris, tell us more about the Amazon Born to
Run. Born to Run. Anybody that starts with a new product on Amazon, the single biggest problem is always, hey, Amazon doesn't order enough of it. And the reason for that is because it's new and their algorithms don't know how much people are going to buy, this, that, the other. Born to Run is basically something you can sign up for. You can commit a certain threshold of spending on AMS, and they'll basically hold your hand a little more through that process and work with you a little more fluidly. Again, some of it goes back to advertising revenue is a very profitable bucket for them, and they like to be on the front end of trends. They just don't take big leaps because they don't have algorithms to back up what they should buy. So that's a little bit of a marriage in terms of, hey, you commit to a certain level of AMS spending, you roll out a new item. The feedback on it has been pretty good, to this point from a lot of vendors. It's been around not too long, but certainly long enough that we've heard a decent amount of feedback on it. So yeah, it's just a new item tool.
Chris, what's the future at Amazon with private label?
It depends on the category. I think that, what we've seen, there's a few different variables as well. I think that that's maybe a slight back burner thing just in the ultra near term because the company is a little bit more focused on growth. I think they were a little spooked at some of the fall off in advertising revenue. Naturally, the more you build out private label, the more inventory that takes away from potentially, advertising revenue from brands. So I feel like the drumbeat on private label is still there, and in the basics categories, there's going to be a lot of it. I don't know if that's, an incrementally more aggressive stance that we've seen before. But definitely basics, we see a lot of it. You know, just because Amazon knows the exact specs that the really good items have. Private label is easier online because the review ecosystem gives credibility to items that have sold well. Amazon knows how the machine works and what keywords to use and things like that. So I still think it's a pretty big threat on the basic side in particular. I wonder if we see a ever so slight back off because of the advertising revenue portion.
Okay, last call. Oh, Barry?
So Chris, when Ron Sargent was running Staples, he made a comment, I think it was a public comment, when they were asking about the impact of Amazon. He said, well, trees don't grow to the sky. And he never really explained. But what the question really was, who is the next disruptor, and when will they appear, in your opinion?
Oh, God. I don't know if I have that one. You know, it was going to be Walmart for a little bit, but, you know, you've had a lot of internal angst there in terms of e-commerce has grown to a big business and is still unprofitable. So I think there's some political headwinds against the growth of that business. You know, Facebook Marketplace is really early. You know, they clearly have a huge and very engaged base. You know, so that's a long-term interesting one. But there's not another material disruptor, and I think that's why, you know, the FTC comes along more and more. You know, if Amazon sees somebody that's truly disruptive in e-commerce, like they'll buy them before they get the chance to become what Amazon is, which is, you know, I think some of the issues people have with Facebook and Google and that sort of thing as well. So I think that the setup of where they are and sort of the difference in the ecosystem now makes it tough for somebody from a pure online perspective to go to the sky, so to speak.
So with Amazon's acquisition of Whole Foods and actually opening up their own stores as well in some selected markets, and we're hearing Wayfair's doing the same, are you starting to see some of these major internet players transition over to a retail format? Yeah,
I think those are all more marketing plays. Like Wayfair is even a good example of, you know, most of that inventory in their, you know, stores is like distressed kind of product, and it's more of a Wayfair showroom type deal. And same thing with Amazon to some extent. You know, it's, oh, these are our best reviewed items, and it's a good spot for them to sell devices, you know, because that opens up other revenue portions as well. You know, I mean, I think the next layer in advertising revenue growth for Amazon is maybe video. You know, on the Fire TV has 35 million users. So I think that's more of the end game from the retail stores than it is, hey, we're going to cross party lines and be a brick and mortar retailer now.
Okay.
Oh, you want me to read it? Department of Justice looking at large marketplaces. How will this change their growth? I'm not in those meetings. That's I think that as they control more of, you know, pricing and things like that in the 3P marketplace, that's a sort of dangerous gray area that'll probably come up. I think that's a little above my legal acumen to really talk about. So I don't have a good answer for you on that one.
Yeah, that was actually my question.
Thanks.
In terms of what the political...
How long have we known each other? And that's the question, yeah.
Yeah, I come from the Washington, D.C. area, and there's an army of lobbyists representing Amazon on Capitol Hill. But there's also a lot of folks in Capitol Hill, a lot of legislators that are looking to see exactly what the implications are of Amazon, in effect, taking over the world. Do you see any actual efforts gaining traction from the political standpoint?
No, and it's not a huge focus of our work or, you know, our really area of expertise. So I'm probably not the guy to answer that question for you. But it's, you know, to this point, it's tricky because the FTC hasn't really, they would have to litigate things much differently than they have historically to really get involved in that arena, but they've definitely sent some messages, I think, that it would be something they're looking into. But that's outside of our realm of expertise. So,
what percentage of the total office products do you see Amazon today, percentage-wise, compared to, say, 5 years ago? And I'm talking about just generic products, binders, pencils, pens.
Yeah, I think that, you know, a lot of the suppliers that we talk to in this arena would say that somewhere between 10 and 15% of their business, they think through Amazon, is flowing through to the enterprise user. That would be the main data point I would go on to come up with the math from that. If you're looking at a mature business on Amazon, 10 to 15% of that volume flowing through to the enterprise end user. If we get into the retail component of that business, the answer is a lot higher. But I'd use that as your benchmark at this point. If I'm a large, traditional office supply business, Amazon B2B is only 10 to 15% of the total. The rest of it's going to more of a traditional consumer type retail, outfit. Now, generally, a lot of small businesses can behave like consumers, so it's a little difficult to pin down an exact number. They'll say it's that much, could be a little bit higher, but yeah.
Chris, on the scenario of Sycamore taking Staples back private, what do you think about the rumor from 4 months back that when they do that, they will leave the retail part out of that public company?
Yeah, I think that's probably more tied to just the level of interest that there would be in the retail side of the business, to the point that they could, theoretically find some sort of buyer or a more forgiving public market if the retail side wasn't part of the equation. So it goes back to a little bit about, your question on the Office Depot side, where, I think the dynamics of the industry from a retail perspective, mean that there's not a lot of value attributed to the retail portion of the business.
Anybody else? Well, please join me in thanking Chris for his time.
Yeah, thank you.
As Susan walks up to let us know what we're doing next, I just want to remind you, you'll get this deck or have access to this deck. And if you didn't get a chance to write Chris's email address down, you're more than welcome to send a message to any of us, and we can get it over to you. Chris has always been very accommodating to our membership whenever you need some information. He's also available to talk to your leadership groups. And so, again, Chris, thank you so much. Appreciate it.